The broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, good evening, friends and traders. My name's Tian Creek and I'll be your host for today's UTP lesson on equity management. And today's the 28th of March 2017, and that makes today a Tuesday. Good morning, welcome everybody. Welcome Dale. Good day Andrew. How are you doing, my friend? Welcome, welcome, welcome. Right, now today I'm going to discuss risk versus reward, managing risk, stops beyond the A, cancel, replace, and emotional intelligence. Right. Now equity management is divided into four categories. The first one is properly planning a trade, then the formula for the preservation of capital, then where to place your protective stop to avoid getting stopped out early, and then the importance of emotional intelligence, the psychology of successful trading, and learning the discipline of not fiddling with your trade. Right, now trading rules to obey when placing a buy order. Every buy entry should have two sell exit orders. If my entry is a buy, I have a bull position or a bullish position. My position is long. I can only exit with a sell either for a profit, and that will be a limit order, or either for a loss, and that will be a stop order. Now trading rules to obey when placing a sell order. If my entry is a sell, I am bearish and my position is short. I can only exit with a buy, and I will either exit for a loss, which will be a stop order, or for a profit, which will be a limit order. That profit should have been a loss. That is a mistake on the manual. I'll get that fixed. Either way, is everybody with me up to this point? Just type a Y or a yes. And remember, you're more than welcome to ask me questions by typing it in your question section box. Okay, beautiful, 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 beautiful. Thank you, Andrew, Dale, Veronica, and everybody else. Now we get to the formula for the preservation of capital. Now percentages mean nothing. The question is, can you be a 30% winner and a 70% loser and still make money? And the answer to that question is a resounding yes. If I have 3 wins out of every 10 trades and I make $2,000 on a winning trade, then I'll be up with $6,000. If I have 7 losing trades and I lose $300 on a losing trade, I'll be down to $2,100. But at the end of the day, I will realize a net profit of $3,900. Right, so even with a strike rate of 30%, where I lose 70% of every 10 trades that I take, or I win 3 out of every 10 trades, then I can still walk away with a profit. Now let's have a closer look at risk-reward ratios. At a minimum, you need to risk $1 to capture $1. This is known as a 1-to-1 risk-reward ratio. With this ratio, you'll need to be right a minimum of 5 times out of 10 to break even. For example, 5 wins at $100 a winning trade will give me $500 profit, while 5 losses at $100 a losing trade will give me $500 loss. With a 1 to 1.5 risk-reward ratio, you'll need to be right 4 times out of 10 to break even. For example, 4 wins at $150 a winning trade will give me a $600 profit, while 6 losses at $100 a losing trade will give me a $600 loss. With a 1 to 2 risk-reward ratio, you'll need to be right 4 times out of 10 to make $200. For example, 4 wins at $200 a winning trade will give me $800 profit, while 6 losses at $100 a losing trade will give me a $600 loss. So I will still make $200 at the end of the day. With a 1-to-3 risk reward ratio, you'll need to be right 3 times out of 10 to make $200. For example, 3 wins at $300 will give me $900 profit, while 7 losses at $100 a losing trade will give me a $700 loss. But I still walk away with $200 at the end of the day. With a 1-to-4 risk reward ratio, you'll need to be right 2 times out of 10 to break even. For example, 2 wins at $400 will give me an $800 profit, while 8 losses at $100 a losing trade will give me an $800 loss. With a 1-to-4 risk reward ratio, if you are just right only 30% of the time, 3 wins at $400 will give you $1,200 profit, and 7 losses at $100 a losing trade will give you a $700 loss. But you still net $500 at the end of the day. So successful trading is learning to keep your losses small and letting your profits run. Stick to the formula. Success is a formula, not a fantasy. Right, now let's carry on with risk versus reward. If I'm risking 1 pip to make 1 pip, and I have 5 wins out of every 10 trades, and I make 50 pips on a winning trade, I will make 250 pips. If I have 5 losing trades and I lose 50 pips on a losing trade, I will lose 250 pips. So I will be break even. A 1-for-2 means I'm risking 1 pip to make 2 pips. And if I have 4 wins out of 10 trades and I make 100 pips on a winning trade, I will make 400 pips. If I lose 6 of my trades and I lose 50 pips on a losing trade, I will lose 300 pips. But I will still realize a net profit of 100 pips. A 1-for-3 risk reward ratio, if I have 3 wins at 150 pips a gain on a winning trade, I will be up with 450 pips. And if I have 7 losing trades and I lose 50 pips on a losing trade, I will be down with 350 pips. But I'll still realize a net profit of 100 pips at the end of the day. If I stick to a 1-for-3 risk reward, but I have a 50% strike rate where I win 5 out of every 10 trades, and I make 150 pips on a winning trade, I will be up with 750 pips. However, if I lose 5 trades and I lose 50 pips on a losing trade, I will be down with 250 pips, not 320. That is a mistake. But nevertheless, I'll still walk away with $500 or 500 pips at the end of the day. If I stick to a 1-for-3 risk reward ratio and I win 7 out of every 10 trades and I make 150 pips on a trade, I'll be up with 1,050 pips. And if I have 3 losses but I lose 50 pips on a losing trade, I will be down with 150 pips. And I'll walk away with a net profit of 900 pips. Right, now let's get to managing your risk. Although you may never quantify how much you can make in a trade, you can quantify how much you are willing to risk and or lose on a trade. Successful traders risk no more than 2 to 5% of their margin account in a single trade. Money managers take average risks of 0.5% and no more than 2% maximum on a given trade. Individual traders take greater percentage risks than money managers, and the important issue is financial survival. What happens if you go through a streak of losses? What if you actually hit your drawdown? Right, now if I'm trading with standard lots, which are 100k lots, and that will roughly equal to $10 a pip, and I'm trading with 1 currency pair at a time. If I have $3,000 in my trading account and I'm risking $500, I'll be risking 16%. However, if I have $25,000 in my trading account and I'm risking $500, I'll be risking 2%. If I'm trading with mini lots, which roughly equal $1 a pip or $1 a pip, and I have $1,000 in my account and I'm risking $50, that means I am risking 5%. However, if I have $2,500 in my trading account and I'm risking $50, I'll be risking 2%. If I'm trading multiple currencies at one time, where I execute 6 currency pairs at the very same time, where I have 6 open positions, and I'm trading with standard lots, which roughly equal $10 a pip, and I have a 50 pip protective stop on each trade, I'll be risking $3,000. And if I only have $15,000 in my account, I'll be risking 20%. However, if I have $75,000 in my trading account and I'm risking $3,000, I'll be risking 2.5%. If I'm trading with mini lots, which roughly equal $1 a pip, and I'm trading with 6 currency pairs, and I have a 50 pip protective stop, and I have $3,000 in my account, and I'm risking $300, I'll be risking 10%, which is overexposing. So I would rather make sure that I have $15,000 in my trading account, so that if I'm risking $300, I'd be risking 2%. Now, do not overtrade your account. Here's an example of overtrading with mini lots. If I have 6 mini lot currencies at a time with a 50 pip stop, and I only have $2,000 in my account, I'll be risking 15%. However, if I have $15,000 in my trading account, and I have the same amount of risk, which is $300, which is 2%, I can sustain 44 consecutive losing trades. So just keep an eye on that. Right, now we get to where to place your protective stop to avoid getting stopped out early, and why the stops must be beyond the A. Now, as the market moves, it moves in A, B, C, D price movements. A trader is looking for an entry inside an AB boundary. No one knows how long the market will stay inside an AB boundary or if it will retrace deeper after you enter. Your A and your B are your latest major levels of support and resistance. If the market takes out one of those levels, it has a track record of continuing to move in that direction. Protective stop loss orders placed inside the AB boundary increase the percentage of getting stopped out before the market moves to the projected D by almost 80%. Placing a protective stop loss order outside the AB boundary and beyond the A decreases the percentages of getting stopped out before the market moves to the projected D by almost 80%. So it's very important, if you can, place your stop beyond the A. Now, because of the potential of the market turning whippy, lashy and nasty inside the AB boundary, you must keep your stops beyond the A. So all protective stops must be below the A in an uptrend. 10 to 15 pips below the A on time frames 1 hour and below. 20 to 30 pips on time frames of 2 hours and above. And just know that the larger the time frame, the larger the stop. So there we have an up AB boundary. Pardon me for that interruption there. So now we have an up AB boundary, and if I place my buy inside the AB boundary, then you can see that the market moved to that D extension without stopping me out. Right, because my stop was beyond the A, my stop was below the A. All protective stops must be above the A in a downtrend, 10 to 15 pips on time frames of 1 hour and below, 20 to 30 pips on time frames of 2 hours and above, and the larger the time frame, the larger the stop. Here we have a down AB boundary, a down ABCD swing. If I plan to sell inside the AB boundary at the C, and I place my stop above the A, then the market should move to the D extension instead of coming back and stopping me out. However, if I have a stop inside the AB boundary, I have an 80% chance of being stopped out. Right. So all protective stops must be below the A in an uptrend. Placing a protective stop loss order inside the AB boundary increases your percentages by about 80% of getting stopped out before the market moves to the projected D. Placing a protective stop loss order outside the AB boundary and beyond the A decreases your percentages by about 80% of getting stopped out before the market moves to the projected D. So there's an AB boundary, then the market retraced to the 50, and if you take a buy over here, then you would have been stopped out. Right, would have been stopped out. But if your stop was below the A, then you would not have been stopped out. Does that make sense? Is everybody with me up to this point? Okay, good. Never trade without a protective stop loss order. If the stop order is too far away from the entry point and doesn't meet your equity management requirements, then pass on the trade. Go find another one. One of the best ways to preserve your equity and protect your investment is to get to a break-even as soon as possible and lock in the profits as the market moves in your direction. Now we get to cancelling and replacing your stop loss order in a bullish market. Before executing your trade, if you believe a new trend is getting ready to start, or the market is moving from a C to a D on a larger time frame, you can lock in profit by cancelling and replacing a protective stop loss order as the market moves in your direction. Now there are two ways of effectively cancelling and replacing. Example number one. If you want to trade as a bull, believing a bull trend is starting or is in place, you will want to trade without using a one cancels the other order. This means you're going to execute your trade with just a buy order and a stop. You won't have a limit. And as the market moves in your direction making new highs, cancel and replace your protective stop loss order to the latest low and lock in the profit. Do not cancel and replace your stop loss order to the latest low until the market makes a new high. Right, cancelling and replacing in an uptrend. Cancel and replace orders to lock in profit. When the market makes a new high, cancel and replace your stop loss order to 10 pips below the last market low of support before the new high. So there we have a buy order. My stop is below the buy order. Then the market moves up and makes a high. Then it retraces, it comes down, makes a higher low. Then the market moves up and it actually takes out that previous high right over there. It takes out the previous high. As soon as I have a higher low and a higher high, then I take my stop and I move it to just below the next higher low. And as the market moves in my favor, I keep on moving my stop just below the next higher low. Eventually the market will retrace and stop me out, but then I would have locked in all these profits. Now we get to cancelling and replacing a stop loss order using an uptrend line. Before executing your trade, if you believe a new trend is getting ready to start, or the market is moving from a C to a D on a larger time frame, you can lock in profit by cancelling and replacing a protective stop loss order as the market moves in your direction. So here's example number two. If you want to trade as a bull, believing a bull trend is starting or is in place, you will want to trade without using a one cancels the other order. You'll execute the trade with just an entry buy order and a protective stop. You won't have a target. You won't have a limit. Now, as the market moves in your direction making new highs, cancel and replace your stop order along the outside of the uptrend line 6 to 8 candles back from where the market is, locking in profit. Keep moving your stop loss order up along the outside of the uptrend line, locking in profit until the market reverses and stops you out. And this can be applied on all time frames. Here's an example. Cancel and replace. As the market moves in your direction making new highs, cancel and replace your stop order, or just move your stop order along the outside of the uptrend line, 6 to 8 candles back from where the market is, locking in profit. So if you enter over here and your stop is below your entry and the market starts moving in your favor, you can draw a very aggressive uptrend line. And as the market moves up, you just keep on moving your stop on the outside of the uptrend line until the market eventually breaks that uptrend line and stops you out. But then you would have locked in profits. Right, now let's have a look at cancelling and replacing your stop loss order in a bearish market. Before executing your trade, if you believe a new trend is getting ready to start, or the market is moving from a C to a D on a larger time frame, you can lock in profit by cancelling and replacing your predicted stop loss order as the market moves in your direction. Now there are two ways of effectively cancelling and replacing. This is example number one. If you want to trade as a bear, believing a bear trend is starting or is in place, you will want to trade without using a one cancels the other order. You'll execute the trade with just an entry sell order and a predicted stop loss order. As the market moves in your direction, making new lows, cancel and replace your predicted stop loss order to the latest high and lock in the profit. Do not cancel and replace your stop loss order to the latest high until the market makes a new low. So you need to see a new low being made. Cancel and replacing your stop loss order is your reward for educating yourself about how the market works. It's not about greed. There we go. When the market makes a new low, cancel and replace your stop order to 10 pips above the last market high of resistance before the new low. So if I enter over here, my stop is above my entry. As the market moves down, makes lower lows and lower highs, I just keep on moving my stop to above the latest high of resistance. There. And as soon as the market then starts to make higher highs and higher lows, it will eventually stop me out, but then I would have locked in a whole lot of profit. Now we get to cancelling and replacing your stop loss order using a downtrend line. If you want to trade as a bear, believing a bear trend is starting or is in place, you'll want to trade without using a one cancels the other order. You'll execute the trade with just an entry sell order and a predicted stop loss order. As the market moves in your direction making new lows, cancel and replace your stop order along the outside of the downtrend line 6 to 8 candles back from where the market is, locking in profit. Keep moving your stop loss order down along the outside of the downtrend line, locking in profit until the market reverses and stops you out. And this can be applied on all time frames. Cancel and replacing your stop loss order is your reward for educating yourself about how the market works. It's not about greed. So there we go. As the market moves in your direction making new lower highs, cancel and replace your stop order along the outside of the uptrend line, back from where the market is. So if I enter the market over there, I can draw a very aggressive downtrend line and start moving my stop along the outside of that downtrend line until the market would stop me out. Right, so now we've discussed properly planning a trade, then the formula for the preservation of capital. I've also discussed where to place your protective stop to avoid getting stopped out early. And now I'm going to discuss the importance of emotional intelligence, the psychology of successful trading, and learning the discipline of not fiddling with your trade. Now, what is emotional intelligence? It's the capacity to be aware of, control, and express your emotions, and to handle interpersonal relationships judiciously and empathetically. It's the capacity to control your emotions in any stressful situation or perceived personal crisis, enabling your action to create a positive and a productive outcome. Emotional intelligence is the key to both personal and professional success. Right, so if this is your trading plan, focus on the logical side of things, stay realistic, stick to your plan, and don't lean over to the emotional side, right? By fiddling with your trade, or maybe taking profits early, or moving your stop if the market moves against you. Stick to your plan. Success is a formula, not a fantasy. Now, disciplines to follow for successful trading. Educate yourself on how the market works and thoroughly analyze and plan your trades. Create a trading plan and trade that plan. Do not deviate from your plan without developing another comprehensive trading plan. quantify any potential loss. Don't risk everything on one trade, and do not overtrade your account. Remain focused and do not marry a trade. Be quick to change directions if that is what the chart is dictating. When in doubt, stay out. A common problem that most traders face is trying to force the market to move in their personal direction. This is a very unsuccessful and devastating strategy. Never try to force the market to do what you want it to do. Recognize how the market is moving and then trade in that direction. Create the trading plan and trade your plan. It's not about what you want. You must learn to want what the market wants. Then trade in that direction. Want what the market wants, not what you want. Now, champion traders when they trade first and then enter the market, while defeat the traders enter the market and then seek to win. Right. Now, when to pass on a trade? You should pass on the trade if and when you are tempted to get in for whatever reason. It requires a stop-loss order that doesn't meet your equity management. If you have not had the time to make a trading plan that includes a clear entry point and a stop and a limit, then don't trade. If for any reason you feel uncomfortable, then don't trade. If you're not really clear on what you are doing or do not understand the rules, then don't trade. If you feel you are being emotionally self-forced into making the trade, or if someone else is forcing you, then don't trade. If you cannot afford the loss, then don't trade. MTI's goal is to teach you to become an unconsciously competent trader. If you have traded unsuccessfully, you are unconsciously incompetent and will continue to repeat your mistakes. Recognizing that you repeat your mistakes takes you to conscious incompetence. You are now aware. At least you are aware of your mistakes. Now, finding help to learn new successful trading skills and techniques and methodologies, as well as establishing successful trading habits. Those habits are very, very important. This will then move you to a state of conscious competence. You have to think about every detail as you do it. Continuous and unyielding repetition of those successful skills creates winning habits and takes you to a state of unconscious competence. Your key to success is the law of attraction. The law of attraction is a name given to the belief that like attracts like, and that by focusing on positive or negative thoughts, one can bring about positive or negative results. What we reflect on, therefore, radiates from our being and creates circumstances and events that mirror what we are thinking. So if you think positive, you will reap positive. If you think negative, you'll reap negative. Has anybody ever read The Power of Now? That is such a profound book, The Power of Now. If you haven't, then I suggest you go and get that book. Okay. Any questions? Any questions on equity management? We just keep on learning there, Andrew. I learn every day, my friend. Yeah. Okay, guys. Well, thank you for joining me in today's UTP lesson. I wish you a wonderful trading day ahead, and I look forward to joining you in tomorrow's Endless on Demand. Thank you so much. Have a great one, and try and get The Power of Now. It's a good book to read. Cheers.